Okay, this is Rhonda Thomas, and we are getting ready to do Financial Accounting's Exam 2 review. This is going to cover chapters 6, 7, 8, 9, 10.
Mike Thomas would like to talk to Rhonda Thomas. It's Mike Thomas for Rhonda Thomas.
Just a minute. Okay, we're going to start with chapter 6. Chapter 6 is all about inventory. Okay, chapter 6. And this is going to be, so if you look at each chapter, we have basic exercises that we have done, and it's the basic exercises that I'm going to try to test you on in each chapter as we review. And this review is worth 50 points. So just a second. Okay, so inventory. Inventory is our first asset that we went a little deeper dive into. Okay, so we have to remember that inventory is an asset, right? With a debit balance. Sorry, all the assets have debit balances. So we've got 4 assets and 1 liability chapter. Okay, and we're looking at, I'm turning to it in the book too, just so I can have it in my mind here. Okay, so, all right, the cost flow method. Now we know there are 3 cost flow methods. Okay, if you're talking about costs and how they flow, there is first in, first out, first costs in, first costs out. And that's the one where, we've got first in, first out, last in, first out, and weighted average here. Okay, now this is perpetual inventory. Determine the gross profit for April and ending inventory on April 30th using the first in, first out, the last in, first out, and the weighted average. Okay, they actually calculated the weighted average for us. Okay, right? Yep. So if you want to open, here's how it's going to look. Okay, I'll do first in, first out. They didn't have any. Okay, they didn't have any to begin with. So if you look at the little T account here, let me put these amounts in. Our first purchase was 157. Our second purchase is 158. Our third purchase is 159. We have 3 available, right? 3 available. It says assume that 1 unit is sold. It is sold at $2.04. Okay, sold at $2.04 on April 27th. So there's your sales price. So when they ask you what the gross profit is, you'll have to subtract one of these from the gross profit or from cost of goods sold. All right, so let's see here. So if this is first in, first out, the first costs that are sitting here are going to be the first costs sold. Okay, so we're going to sell the 157. That's going to be the cost of the goods sold, right? So then when you take, let me put the sales here, it's going to be 204. And when we subtract 157 from it, we get a gross profit by using our first in, first out for that one item of $47. Okay. And then that left, all right, that left the 158 and the 159 there. All right. So there are 2 left because only 1 sold. So we had to figure out which one of these we were going to use for the cost of the one sold. And since we're using first in, first out, that's the first purchase that we make. So then that becomes the amount of the cost for the items that we sell. All right. So once again, ending inventory then becomes those last 2, 158, 159 added together, right? Be 317. But the nice thing about this is however much is available, right? I always recommend you calculate an available amount, and they've even got it right up here, an available amount, and then they've got the average, and the available amount, however much was sold, plus however much is in ending inventory, will always equal the available amount. So $157 sold and the cost of the ending inventory, when you add those two together, you get $474. Yep. Okay, let's move on. Now we're going to do last in, first out. So I'm just going to repeat what I have here. Okay. And last in, first out means that the last one that came in is actually going to be the one we're going to sell. So that means the first one is still in ending inventory, and so is the second one. So once again, the cost of what you sold. So once again, we're selling it for $204. The cost is $159. So this gross profit is 45. So the one before was 47. So that's pretty close. And if you don't get a pretty close number here, you've calculated something incorrectly. So then the amount that's still in ending inventory after LIFO, okay, I want to make sure this adds up okay, is 315. Yes. So 315 plus 45 equals the 474. Yep. And 47 plus 317 equals the 474. All right, now we're going to do weighted average. Weighted average, they've done the math for us, but I'm still going to put it in anyway. Okay, so we've got a weighted average cost of 158. So that means that one item equals 158. So then if you take the sales price of 204 from the problem and subtract 158, you get 46. And weighted average is always going to fall in between first in and first out and last in and first out. Okay. FIFO and LIFO. And then 45 plus what? Okay, 45 plus, so let me put this on here, 158 and 158 is the average cost. So it looks like 316. Okay. Yeah, 316. All right. And then, like I said, I want to add up 158. So 46 is the gross profit from that one. Let's check our work. Uh-oh, hang on. So this should be actually 44, I think. Let's just see. Nope. Okay, hang on. So 46. Sorry. What did I? There we go. There we go. I just missed it. Okay. So I have calculated each cost flow in its own little T account. And then below it, I've calculated the cost of the goods sold and then the gross profit. So let me finish this here. So I get my gross profit to show. So you would want to keep track of all of that. But the good news is you have the same sales price for each one of those. Okay, the same sales price. Oh, we want to add. There we go. 45. There it is. Okay, so once again, this one's right in the middle. Okay, moving on. Let's see what else I picked next. Okay, beginning inventory. This is perpetual using weighted average. Okay, weighted average. So let me go ahead and last time I did it, I did FIFO, first in, first out, but let's do weighted average. I think of all of they say that first in, first out is the most popular, but I think that a lot of businesses use the weighted average method but luckily we have computers now that can help us with that. So I got to get rid of that G there. Okay. And this is perpetual balance. So perpetual balance means that you're constantly going to know what remains in inventory after every sale and after every purchase. So first of all, this is the month of October. So that's still standing. And I'm going to put weighted average here. That's our cost flow assumption. So we're going to begin inventory. Okay, we're going to begin inventory. So how many do we have in the beginning? In my problem, I have 330 items at a cost of 11. Okay, so I'm just going to put this number in here and then I'll worry about calculating everything else. So just bear with me a minute. Okay, so then, all right, so let me do the math here. Okay, we're going to take 100, we'll take 330 items times 11. Okay, so we started with 3,630. Okay, and we're just going to go ahead and work this through. And then we'll go answer the questions. Okay, the first sale, all right, which happened on October 13th, sold. So let me get this out of here. Sold 180 items. Okay, well, it had to come out of the $11. There was nothing to average. Okay, there's nothing to average. So 180 items at $11. And we're going to do the math there, equals 180 times 11. So 1980. And then the second purchase was October 22nd. We're purchasing 350 units at, a cost of 13. Now our last cost was 11. So $13 is within relevant range. Yep. So in here, we're going to put equals 350 items times $13. All right. So there is our new purchase. Okay. New purchase. Now we have to do some weighted average. Okay. Now we have to do some weighted average. So I'm going to move over here to the side. All right. So, okay. So here's what we're going to do. I'm going to take this out and I'm going to take this out. Because the first thing that says is, assuming a perpetual inventory system using the weighted average, determine the weighted average unit cost after the October 22nd purchase. Okay, so what we've got to do is there were 130 items and we sold 180. So I'm going to show you a subtotal now. All right, subtotal. Subtotal is, right, if you take 130 minus 180. Okay, so we're going to have 130 minus 180. 130 items minus 180. We have 150 items at $11. So the remainder, okay, I want to put the at sign there, at $11. So that's how many we had remaining before we made a new purchase because we had a sale. Okay, so I'm going to put this over here. So we're going to put all right, so let me calculate that right here because that's how many is remaining after the sale. All right, so 150 times 11. Yep, so we've got 1650. So we're going to bring this over here because we're trying to get a weighted average. Okay, we're trying to get a weighted average now after this purchase. And I'm going to move that sale down so that we have a little room here to understand it better. All right, so what we're going to do is we're going to count. So if you have 150 and 350, that's 500 items. 500 items. And then we need to come up with an average cost. All right, so I'm going to do the average cost over here. So average cost, average item cost. Okay, we're going to equals the amount that we had remaining after the first sale. So let me bring this over here. So this is going to equal this amount right here. Yep. And then we need the amount from the purchase. We're going to add those two numbers together. Okay. And there's going to be your total for your. Got it. Okay. So the total. Nope, that's not what we want. Just a minute. It's not working the way I want it here. Hold on. Okay, so we want to add what was left over after that first sale to what we now have. So we have $6,200, and these are all dollars. A lot of times it helps to label them. And then we're going to divide it by the 500, right? It gets divided by 500. So, and so I'm going to put, okay, so here is the average cost. Still going to move this down a little bit more yet. Insert. So sometimes weighted average takes a little more, but once you know the cost, if you don't get any more purchases in, then that average cost sticks until you buy more. Okay, so we're looking at a total of 6,200 that we need to divide by 500. Okay, so here is the average cost. So let's take the total divided by 500 items, and we're looking at a cost of 12. Yep. So here it is, cost of 12. And the new available amount, right? Amount available is 500 at 12. So this is going to be available. It's always good to calculate available. And we're going to add what was sitting here after the sale plus what we just purchased. And you're going to find that it's $6,200. Okay, so there it is, $6,200. And I'll put a little point that shows that this was a new, so this is the new subtotal. Okay, this is the new subtotal that's available, 500 at a $12 cost. Okay. So anything we sell is going to be $12 a piece. So here is our sale. We're going to sell 300 units. Okay, let me take this number out. So now we're ready to sell. How many units do we have? 500. We're going to sell 300 units. And we're going to have to do the math for that. So 300 times 12. 300 times 12. Which is the price. Okay, let me get rid of this because this is a weighted average. All right, so 300 times 12. I'm going to put that in here. 300 times 12, 3,600, right? Which leaves us, okay, so let me get rid of all of this. So what they want to know is, what is the cost per unit? Well, we determined it was 12. And then assuming a perpetual inventory system using the weighted average, determine the cost of the goods sold on October 29th. So here is this sale. 300 units at 12. So they were $3,600. And now they want to know how much is in ending inventory. Well, we're going to be able to calculate that there are 200 items left at $12 each. Okay, so do the math for that. Equals 200 times 12, and you get 24. Okay, so there is the answer for the ending inventory. Okay, the ending inventory. All right, and now we have, and these two numbers must add up to what we had available. Yep, and they do. 3,600 and 2,400 equals 6,200, but the amount in ending inventory, $2,400 of 200 items. Okay, we're going to check our work. Okay. Watch out. Watch for those 2 decimal places. I just about got robbed. Okay. Let's see here. 2 decimal places. Boy, it doesn't give you any slack for that. Okay. Okay. Well, all right. Hang on just a second. Let me see what's happening. Wow. Really? Okay. Maybe let me look again. Okay. Let me do, oh yeah, we need to make sure we're doing, there it is. There it is. 12.40. It's not just $12, it's $12.40. So that's going to make a difference. Yep. My fault. Sorry about that. Okay, so then let's see here if this is, oh, okay, so now I need to take it times 12. All right, so we're adding that up for availability. And then, oh, I need to take 300 times 12.4. Yep. And then 200 times 12.4. So that's the difference. And I apologize, I haven't really had this happen very much in class. So then do the 200 times 12.40 here. So we didn't add 40 cents. So we're looking at, for what sold, 37.20 and 24.80. And if we add up 37.20 and 24.80, we add it up, it adds up. So I'll just do that here. So we want it to add up to $6,200. That is how much it must add up to. Because what you sell and what you still have in inventory has to add up to what you had available. So now let's see if we got it. Okay, looks like we did. Sorry for the misstep on that. All right, onward we go. Let's see what else we got. One more for inventory. Okay, once again, this is FIFO and LIFO. All right, and so let me make a big place here and I'll throw a little bit of calculations in here. Okay, so this is going to be number 3. And you'll have to do the FIFO and LIFO for both of these. Okay, so I'll just go grab the FIFO and LIFO right up here, which should work. Let's see if we can't make it work. Okay, this is the month. No, this is for the year. Yep. Year end. Okay, let's see what it says. The following units of an item were available for sale during the year. Okay, and it looks like they have a selling price of, all right, let's just go through this. So we're going to start with FIFO. Okay, we're going to start with FIFO. We have a beginning inventory, and I'm going to put that out here, and then I'll put the sales in. The sales prices vary, so I'm going to put sales prices vary from $72 to $75. So we want to be sure to use the one we need. All right. And then we're going to have a beginning. So we're going to begin with 27 units at $48. Okay. So let's do the math to see how much is sitting there. Okay. $48. It looks like it's $1,296. Don't worry, we'll do LIFO here in a minute. Okay, and then we had a sale. So I'm going to insert a little bit here so we make room for a sale. All right, so our sale is going to be on, so we're going to sell 22 units. 22 units at $48 a piece because there are no other costs. We have to sell what we have. So 22 times 48 is $1,056. So far we're making our way to the flow, right? We began with some inventory and we made a sale from those inventory. Then we made a purchase. Okay. So our first purchase, we purchased 18 items at a cost that should be pretty close to 48. It's 51. Okay, 51. Yep. Okay, so we're going to calculate that. I'm just going to get rid of all of this. I'm just going to be repeating it anyway. So I'm just showing you the flow. All right, so then this amount equals 18 times 51. So there's 918. So we have a remaining amount that would be a good idea to keep because this is perpetual. When you have perpetual, then you have a remainder after every sale and after every purchase. Okay, so I'm going to put that here. And if you have 27 and you sell 22, then you have 5 at 48. Okay, so let me do the subtraction here. And there it is. And okay, so there's what we had after the first sale. And then the amount that we're going to have after this one. So 5 and 18. Okay, and we've got to keep the costs separate. We've got to keep them separate. So now we have 5 and 18 is 23. And I'll put a little star there. So we got 23 at, and it's going to be a mixture of both of those, right? So you have to repeat what this is. So I'm just going to put 23 available, but you'd have to look at them based on their actual costs. And I'm going to add these two together to get a total of the inventory after the first sale. Okay. But I can also show you a little quicker way of doing this. Okay, a little quicker way of doing this. So this is kind of it's not cheating, it's just thinking about it. All right, so that's fine. So here's how much they had available. It's going to keep you from going through all of this. Okay, so let me see if I can help you with this. So let me get rid of these from the last problem. because we have 2 sales and 2 purchases. But what they want to know is what is the total cost of the ending inventory? They just want to know how much is down here. All right. And here's an easy way to do it. So we've already gone through this. I'm going to go ahead and finish it, but I'll show you an easier way to do it because I just don't want to leave it be. All right. So then we have a sale, right? We have a sale after that first purchase. So the sale is for 7 items at, and I'm just talking costs, okay? At, and this is first in, first out. So 5 of the items, yep, 5 of the items is all going to be that $48 cost. Yep. And then we're going to break into 2 of the, okay, so then 2 at the $51 cost. Okay, we'd have to add that together. Okay, and so I'll show you that coming out. So this is a sale, and that means we have a few left of the $51, right? So let me get your sales here equals. I'm going to do a formula, and then I'll show you an easy way to do this. 5 times 48 plus 2 times 51 added together, 342. Okay, 342. So we're going to have a remainder again after that sale, and we'll put it here. So this is the remainder, and there are 16 left. We sold 2 of the $51 cost. There's 16 left at the $51 cost. Okay. And we would want to know what that is. Like I said, we're just making the flow here. Okay. So that would be 816 after that sale. And then the last one is another purchase. So we had 1 sale, 2 sales. We have 3 sales. Okay. We have, okay, after the sale, we're going to make another purchase. Okay. Yeah. It gets a little long. That's why you'll be happy to see my example. So now we're going to purchase. This time we're purchasing 30 at 53. And that's pretty close to 48 and 51. All right, so let's do the math for that one. So 30 times 53. Okay, there you go. And then you have the 16 and the 30. So you have 46 available that you can sell. But we got to add these 2 together to know what the total is because they're 2 different costs. Okay, they're 2 different costs. So the 46, and did I put a line there? Yes. Okay, I'm going to add those 2 together. So drag it up. There we go. So there's how much we had after the purchase. Now here comes the last sale. My goodness. Okay, first in, first out. So the first ones that are going to go out are the $51 cost. So how many are we selling? We're selling 27. So all 16 of those go. So a sale of the 16 at the 51. Okay, and we'll do a calculation. And then that, all right, they got 27. So then we need 9 times 53. Okay, so let me do, okay, very similar, equals 16 times 51 plus 9 times 53. Close parentheses. That means that we have, and they even told us, ending inventory. Okay, ending inventory has how much left? Okay, so we can actually make sure to prove how much they have left. So if we had 27 and we sold 22, we had 5, and 5 and 18 is 23. So 23, they sold 7, then we had 16, and then we added 30, then we had 46 items. I'm just thinking of how many we have left, and then we're selling 6. So I believe we have 30 items left. 30 items left, and they are in the cost. Okay, 30. Nope. We have, because we sold 9 of the 30. So what we have left is 30 minus 9 is 21. So I think we have 20. Oh, it says 19. Sorry about that. There are 19 on hand. Okay, 19 on hand. That's fine. Let's just double check our math here. Double check our math. All right, so we have 19 remaining, and those 19 all fit in this $53 cost. That's what I was going to show you to do to begin with. So if you're using first in, first out, all you really have to do is say, well, how many do we have at the end? Well, we have 19. Well, 19 left over fits into this last purchase here. Yep. 19 goes into 30, right? And so we have 19 at a cost of 53. So that is your ending inventory for first in, first out. I know that's much easier than going through this whole thing, but sometimes they want to know the cost of, so I went ahead and did it. And I may actually have, go back and look, but anyway, I'm going to put 19 times 53. So it looks like we have 1007. So let me double check my math here just so that I can. All right, so we started with 27 items at 48. We sold 22 of them at 48, and that left us with 5 at 48. Okay, so there are those 5. And then we bought 18. So 5 and 18 are 23. Okay, and if we take 18 times 51, then we have, this is what we purchased, and this is what we still had, and we have to keep those separate. So then when we sell 7, 5 of those are going to come, all 5 of those are going to be gone. So 5 at 48, and then 2 more at 51. Okay, so let me go back. There we go. Hit enter. So that should be good. And I know this takes a little while, especially when you can't find your mouse. Okay. And then we sold 7, which is this. And then let's see, we had 16 left of the $51 cost because we had 18. All right. And then we bought 30. And then we had 46. And then we sold 16. Hold on. Second purchase was 30. Our sale. Okay, hang on. I think I've got this wrong. All right, so we're going to sell all 16 of those. 27 minus 16 is 11. So I'm missing 2. So I really need 11 here. There's where I missed it. Okay, there's where I missed it. So, all right, so I need to redo this. It's 11 items at the cost of 53. So then let's see here. If these two add up to 46.0, all right, 46.06 is how much there was available before this last sale. Okay, so if you want to add what's ending inventory plus what we sold, yes, there it is. So that's kind of like a check number, right? This is going to be ending inventory. Okay, ending inventory is right here, and this is just our check number. That's all right. And I don't think we need to know the gross profit. That's all right. So we're done with that. Okay, so there's our first one. Now we'll make this next one easier. I just wanted to show you how this would look. Okay, and I am going to just get rid of this, and I'm just going to copy and put it in there. So, all right, let's get rid of this. Okay, so let's do LIFO now. So I'm going to make some room. Gosh, some of these inventory ones get a little lengthy. I understand. Okay, so we only want this. Okay, and so I'm not going to redo this really for LIFO. Here's what we're going to do. We're going to go down here to the bottom. Okay, we're going to go down here to the bottom. Now this is going to be the same flow. Okay, but the costs are going to be different. So the first part is just fine. First part is just fine. It's just when we sold 7, those 7 are all going to be, all right. So I guess I will change it. So this sale of 7 all can go in the last cost we bought, which was 51. So we're going to have 7 times 51. So here's the sale. A sale of 7 at the $51 cost. A sale at $51 cost. Okay, and that just needs to be 7. I said I wasn't going to do this, but now here I am. Okay, so now we want to put equal sign. But, all right, so there, and then you still have to carry down this old layer. Okay, you carry down. So let's just go ahead and see what happens. Okay, so there's the sale. Now we still have the 18 and we sold 7. Oh, I'm sorry, we still have the 5. Okay, we still have 5. Now hang on. Okay, we still have the 5. So the 240, and then we have, so we had 23 available, we sold 7, now we need 16. Well, those 16 are going to be made up of 2 costs. Okay, so we need a little more room. So the 2 costs are going to be the 5 at the $48. Okay, so I'm just gonna see, there might be times you have to go all the way down through. So 5 at 48. A is 5 at 48. Let me put an equal sign here. Yep, and then that one keeps coming. And then 7 from 20, or 23 minus 7 is 16 remaining at 51. Okay, so that 16 times 51. Okay, and then that has to be added together in order to get a perpetual total. Okay, perpetual total. Okay, but you should be able, we'll see if we can work it the other way. I guess I just don't want to miss anything. Okay, equals. There it is. So there is how much, by the way, these are all dollars. Okay, these are all dollars. So sometimes it helps to see that. And I don't think they want, okay, so then this is $1. This is, okay. All right, and then we're going to make a sale. So the next sale is after the purchase, after the second purchase. No. Okay. So we've got beginning, sale, purchase, And now we need a sale. Okay, we need a sale of 27 units. Okay, so we're going to get this out of here. Okay, here comes the sale. And we're going to need all 16. Okay, so hang on. So the sale is going to be 27. So we're going to use all 16 first because they're the last ones in. Oh, we don't have a 53 one. Hang on just a minute. That was the remainder. I'm sorry. This is the remainder, not a new purchase. That's okay. New. All right. So now we do need a new purchase. Okay. Now we're doing another purchase. So the next purchase is going to be 30 units at 53. So 30 units at 53. 30 units at 53. Okay, we'll go do the math here. Equals 30 at 53. Okay, there's that. We're going to add it to that. Okay, to know how much remains. So all of these are still going to be here, right? Mm-hmm. So we're looking at 5 and 6 is okay. Okay, so then we've got all of those to carry down for the next sale. Okay, so the next sale is going to be 27. All 27 of those units fit in there. Okay, all 27 of those units. So this is a sale at 27 units at cost of, oops, $53 because those were the last ones in there, right? Last ones in there. So equals 27 times 53. Okay, I got 1431. And then, okay, and so how many do we have remaining now? This is now we need to come down here. But I am going to do this. I'm going to show you that we would have had to have a total, but five, and I've just got to add it together. So 5 plus 16, that's 21. 21 plus 30 is 51. Okay, so then we had 51 items before the 27. Let me see here. I don't think so. Nope. Okay, so we had 23 available altogether, and we sold 7. 7, so this is going to be 11. Okay, here's where I went wrong. So 11 items. We still have the 5. They're carrying down, and I think the 5 is going to be down here too. Okay, so let's put 5 of those. Here's the easy way to do it. 5 at the oldest cost of 48. Okay, so let me take this out. Okay, equals 5 times 48. Okay, there's 240. And then the rest are going to be out of, actually, there's going to be 3. All right, so there's going to be the 11 at 51. Because we didn't sell out. Now, how many is left of this 30 here? There's 20, there's 3 left. Okay, there's 3 left. 11, 5, 11, and 3. 5 plus 11 plus 3. Yep, that's 19. Okay, so there are 3 left at 53. Okay, so we're going to need all 3 of those, and then we can add those up. Now, you can't do this. You got to kind of see what's going to happen. Yep. So I like those tables, right? I like the table. So it's not going to be 19 at 53. Here are your 19, but they're at 3 different costs. And then we're going to add those up. So 11 times 51, and then 3 times 53. Let's add those up, and that will give us our ending inventory. How many did we have? 19 items. Okay, sometimes it's good to remember how many we're supposed to have so we can keep straight. And once again, these are dollars. So we're going to add those together. I got $960. $960 plus 1431. I'm going to do a little double check here. That should add up. So here's our remaining total here. So we had 16, so we had 46 items after that first sale. And we're going to add those together. So let's see if we can add this and this. Okay, that doesn't look like that's going to make it. So let's see here. 5 times. So once again, wow. So LIFO becomes a little bit harder. I know. So I don't think I'm right. Nope, I got it. Okay. Okay, we're going back up to FIFO now. 1007. Okay, 1007. So, but yikes. Look at the difference. We had 19 items at a $53 cost. That was our last cost that we brought in a purchase. And all 19 of them fit in that in 30, right? Without needing any other costs. Well, down here, our 19 items are 5 at 48, 11 at 51, and 3 at 53. So it can get really complicated when you have to keep carrying a certain cost down. Okay. Let's see if I got that one right. All right, good. Okay. Woo. That was tough. Let's move on. Let's move on to petty cash. Okay, petty cash. I'm going to use this one to establish it, right? Petty cash is just a cash account that you keep for incidentals in a business. Okay, incidentals. Let's hit enter and get rid of these. Okay, if I have to do another video to finish this up, I will, but I just want to make sure that we get this done for you. Okay, so you can, I think inventory is pretty tough, or it can be. And that's the first asset that they really want to cover, because in chapter 5 we added products, so we wanted to be sure to do assets. Okay, so okay, I think I'm okay. I'm just trying to save some time here, but sometimes I think it's taking more time. All right, we're getting ready to do a petty cash. So this is going to be number 4. So petty cash, delete. All right, so it says, journalize the following petty cash transactions. Issued a check for $850 to establish the petty cash fund. So we took $850 out of the cash account and put it in here. Okay, we put it in petty cash. So putting it in petty cash, so we can keep track of how much we're keeping in there, because sometimes people forget, and that check is coming from the regular cash account. So you should be good there. So now we're going to reconcile it, right? We're going to reconcile it. So let me get rid of what I have here. All right. petty cash reconciliation. Okay, it says that the amount of cash in the petty cash fund is $290. Well, we're supposed to get up to 850. Okay, 850 is our total petty cash fund. It says that we spent $329 on store supplies and miscellaneous 207. Okay, so this adds up to 560. So we are going to see how much short we are. So we had the actual cash and the receipts, right? That adds up to 560, but we're missing some money. The missing is how much the total should be minus what we can account for. Okay, so we could only account for, so we've got, I believe, $290. The amount of cash on hand is $290. So if you add up all of these, I'm going to do a check figure here. Okay, we're going to add up all of these up above. Okay. Let me go fix it one more time. We want all of these added up. And oh, it's still doing a reference. Okay. Good enough. Oh, all right. Doesn't like it. Okay, let's move over. So we know our petty cash fund is supposed to be 850. So let me go ahead and just do my regular sum here. Okay, so now let's see how much. That's not the right amount. Just a minute. So we can explain D81. No. Okay, what I want to do is add up these three here. Okay, equals the sum. We'll just add these up. Okay, 826. We're actually short $24. Okay, $24. So 24 and 826 should equal 850. So one more time, we're going to add those two together just to make sure that it comes to 850. Yes, it does. Yes, it does. So now we need a check for $826 from the cash account to put back in the drawer. Okay, back in the drawer. And actual cash should be $290. No, the actual cash and petty cash fund should be, so we spent $560, which left us with $290 basically. Wow. Okay, that $290. And then we're going to get a check for $826 from cash. So down it goes. Now this is the cash account, not the petty cash. We got to go get a check from the real cash account. So, and then we need to record where this was put. So we put store supplies gets a debit for $329, and miscellaneous selling expense gets a debit for $207, and then short and over. Remember, cash short and over is a debit or a credit, whichever one you need it to be. Sorry about that. Okay, so for some reason they do not like that. Okay, 826. Let's see what I had there. 826. Okay, maybe okay, let me see. 329. Oh, that's the amount we had to explain. Okay, so the amount that we're going to get the check written for is actually, okay, here's what is the amount we can explain. We can explain the actual cash plus these, because they have receipts. So that's why that is. But then the amount that you need to put back is the receipts that you have plus that short. So, okay, we want to be able to see that. All right. So you got to know how much you need to put back. Sum, open parentheses, close parentheses. Okay, you need to explain 560. So here we go. Sorry about that. 560 goes there. And no, no. Sorry. I put it in the wrong spot. Leave petty cash alone. The only time you mess with petty cash is I went against my own rule. The only time you mess with petty cash is when you're establishing the fund or when you're reducing the amount you're keeping in the petty cash drawer, right? So we are going to do 560 because that's what makes this balance. Yep, there we have it. That's reconciling petty cash. Okay, reconciling petty cash. Line up how much is actually there, how much receipts you have. Don't worry about what you can't explain. No receipt can explain the cash short and over, which was 24. Okay. And then this is the amount of the check. Amount need to restore to petty cash. And you always cut the check out of here. So here's what it's going to look like. Here's the credit, and we do a 207, and we do store supplies, which I think is over here. Yeah, store supplies of 329. There we go. All right, we got it. Let's go on. So cash has three main topics. Cash has the cash drawer, petty cash, and cash reconciliation. So this is going to be using the cash register here. All right, so we will save our petty cash or our cash reconciliation here for something else. Okay, so let me make some room. Okay, so this is going to be that was number 4. This is number 5. Okay. Okay, we're going to use some T accounts here. So we don't need any of this, but we do need cash short and over, and we need sales. Okay, so we'll just get rid of this. Okay, so sales. When you're dealing with a cash register, you have your actual cash, which is what the actual currency in the drawer, checks, the dollar bills and coins, right? Okay, so whatever the actual cash is, it says the actual cash received from the cash sales is 87,220. The cash register total is your sales, 87,249. So we don't balance, right? We are longer on this side than we are this side, so we're going to need a debit. We're going to need to debit the cash short and over for $29. So here are our 2 debits and our credit. Okay, so we're going to debit cash for the actual amount that we counted, which was a little short, and it was $29 short, and you use the same account whether you're short or long. It's just which side you're putting it on. And then the sales are going to be the 87,249. Yay, finally one that was a little more straightforward. Okay, now I think we're going to do a cash reconciliation. Okay, let's see what we've got here. Okay, remember, we're going to be comparing our book cash balance to our bank cash balance. So just a moment. Okay, so let's see what they say. And I'm going to show you here it is. What's the reason for the difference in your checking account from your book's point of view from the bank? So the first thing you want to do is put in the ending, the balance, right? The balance. Okay, I always put the bank on the left and the book on the right. So the bank balance, and there was a time that we didn't know what that was until the bank statement came in the mail. And then here's the book balance. Okay, so let's put these in and then we'll figure out where they go. Okay, so according to the company's records, which is right here, it's 25,170. So I'm going to put that over here, 25,170. Okay. And then according to the bank's balance from the bank statement, 26,590. By the way, you have to print out the bank statement and have that at the ready, or at least have that available to prove how much it was. Okay, how much it was. So we've got the two bank balances in. So let me put this one in now and we'll see what that difference is. I got 25,1, no, I got 26,590. Okay, let me get the rest of this out of here. And then we'll put in what we know. But before we get started, we want to know how much is the difference. Okay, what is the difference? So the bank says we have a certain amount and our book says we have a certain amount of cash. And we're $1,420 apart. Okay, so let's see what they're saying. So we're going to make adjustments to both sides to get them to balance. When we're finished, if we do it right, these two balances here will be the same. Okay, these two balances here will be the same. So the first thing we're going to do is they're talking about outstanding checks. It says outstanding checks of $5,110. Outstanding checks, we wrote them, so the adjustment goes to the bank. They haven't seen them yet. 51,110. Okay. The next one, hello, is deposit in transit. Okay. Deposit in transit means that we took a deposit in, okay, but the bank hasn't put it in our account yet. So we really need to add that deposit to the bank balance. Okay. Then we have a check for $270, right? $270 in the payment of an account that was erroneously recorded in the checking account for $720. So this is going to be an error. Okay. And we wrote it for $270. But we recorded it in the check register as $720. So this is what I call a good error. Okay, let's put the bank charge in though. So the bank charge is going to be a minus because the bank knew how much they charged us. So let's put that in. And then now we'll go figure this error. Remember, the error gets corrected on whichever side caused it. So we recorded a check for 270, error of a $270 check. Okay, let's just put $270 check, error 720. So just a moment. Okay. All right. So once again, this is a check that we put in too much. We took out too much cash because all right, so the error of 720, and here's a good way to say it, an error of 720 for check written for 270. So we transposed the numbers and got them out of whack. Okay, so we really should have subtracted 270, but we subtracted 720. So the difference between those two numbers, right? So let's see, 720 minus 270, 450. So we're going to add 450 back. And remember, in balancing a checkbook, we put in the positives before the negatives. And yes, we do balance. We balanced right there. Whoop. Now what's going on? To turn the screen back on, press any button. Ugh. Okay. Good grief. All right. Onward we go. Let's finish up. And then we are going to have to make some adjustments. Oh, nope. Nope, we don't have to make any adjustments in this one. Okay. So let's add the deposit in transit of $4,100, subtract those outstanding checks because the bank hasn't seen either one of those. So our new adjusted balance is $25,580. Okay, well, that's going to also be the balance down here, $25,580. But we had to add back for an error. Okay, so that's a good error. I'd rather have to add cash back than take more cash out. And then a service charge is always going to be deducted. We just have to wait. And I'm going to put in negatives here because I think they want them. But, okay, then let me just see here. All right, let's see what we got. Okay, yep, they want the negatives in there. So if the balance sheet were prepared today, we would have to make the balance equal 25,580. So yes, that's the new balance in the cash account. And yes, it must always balance, of course. And just so you can see it, I'm going to show this to you just a minute. So if we started with 25,170 in our cash account and we made our account go up with $450 because of an error, that error is going to go to accounts payable because that was somebody we were paying, a vendor we were paying. Okay, so when we credit our account, when we debit our account, we have to credit it, and then the service charge is $40, and we make cash go down. And so if we do the math here, we'll have a new balance exactly what we're supposed to. Okay, so this brings our account up to date with anything we may have missed. So yes, it should be 25,580. There we go. Okay, that completes us with chapter 7. So Monty, we're going through the exam 2 review. Okay, it's going to cover 6, 7, 8, and I am recording now.
Okay.
So we'll just go from there. Okay, let's look at a receivable now. We're looking at receivables. Receivables are going to have debit balances. Okay, so this is question number 7. See if we can't pick up the pace just a little bit. I actually may need to do another second video just to, I know those inventory ones take a while, seems like, but. Okay, so this is number 7. All right, accounts receivable. It says journalize the following transactions using the allowance method. I don't plan on testing you on the direct write-off method, except if there is a question, like a multiple choice question that says, what are the 2 main methods to write off? And that is the direct write-off method and the allowance method. And then under the allowance method, there are 2 ways to calculate, right? 2 ways to calculate bad debt expense or the ending balance in the allowance account. All right, so let's go ahead and go through this now. All right, we are Sean McNeely, right? Sean McNeely, we have an accounts receivable with Sean McNeely. It says that on March 17th, we received $320 from Sean. So I'm going to make cash go up 320. Let me get rid of all these other numbers here so we don't get confused. Okay, so when they didn't tell us the balance to begin with, they didn't tell us the balance, but we could find it if we want to. When you have the allowance, when you write off, you make accounts receivable go down. Okay, so the 320 that he sent us, we are just going to make his accounts receivable go down, but the rest of it gets written off. And when it does, it gets written off to the allowance. So we have a credit here. These two get added up. So both of these equal $1,060. That's how much was in his account to begin with. So we wrote off the 320. No, we accepted the 320 because he paid us in check, right? So here comes cash. Here comes cash for 320. Okay, there it is. We wrote off his 740. Okay, so we are making the allowance. So we're writing it off. So here comes the cash of 320. We wrote off the amount of 740 out of his account. And that's what they told us. That it's not something we just had to calculate. And then accounts receivable is going to get the credit for both of these, right? Even though I'm showing them separately, they really are $1,060. Okay. I would have put the two other amounts in as the credits if I was going to do this journal entry, because it gives more detail. It gives more detail. You could have easily put one more accounts receivable going down, and that way you can put an explanation when you want to, right? So remember, the allowance method is a contra asset to accounts receivable. And so, all right, so now it looks like, so that was on March 17th that we got the 320 and wrote off the 740. But now all of a sudden it's July 29th and we are receiving the cash of 740 that we wrote off. Uh-oh. Well, before we accept the cash, we have to reinstate his accounts receivable. So we're going to reverse the write-off. So if you credited to get rid of it, you're going to debit to bring it back. And then we want to credit the allowance so it's back where it was. All right. So back up before we accept the cash payment. Okay. And we're going to make a credit go down in the allowance. So that's almost like that write-off didn't happen. Now we can accept it. Okay. So we're going to show cash going up after we reinstated the account so that we could receive the payment of $740. Yep. And then now back down it goes. And so it was really paid off instead of written off. Okay. We wrote it off at first because it seemed like we weren't going to be able to get it. If it doesn't look like a receivable is going to come in, maybe somebody declared bankruptcy, or you just heard that the longer a receivable goes unpaid, the less likely it will be paid. Okay, so I guess I lied. Here is an example of how do you write off. Okay, how do you write off with the allowance method and without it? Okay. All right, so here's one where I'm going to show you that. So that's fine. Let's do the receivables direct write-off method. Let's do it first. Direct write-off method. So let's start out. They're saying we have $11,680 in accounts receivable. Okay. So this does not have the allowance. So I'm going to take out this, even though I'm going to need it again here in a minute. It'll be all right. I'll rename it. All right. All they have is bad debt expense. Okay. So it says, a firm consulting has decided to write off the balance. So if they're going to get rid of this, they've got to credit accounts receivable. And if they are just writing it off, it's not an adjustment, it's a write-off. So they're actually going to record $11,680 in bad debt expense because there is no allowance. So there's no allowance to use in place of bad debt expense, but we're going to see one where we do. All right, so 11,680. All right, let's go make this happen one more time with an allowance this time. Okay, so we're just going to copy this and bring it down. So once again, this is the direct write-off method. Direct write-off method. So GAAP doesn't really like that one. They would rather you use this one. But one more time, let me copy this and bring it in. So now we're going to do the allowance method, and I'm going to put that allowance back where it was. Okay, we're still starting with the 11,680. This is the allowance method. They're still going to write it off, but they're going to write it off as a debit to the allowance for doubtful accounts. Okay, allowance for doubtful accounts gets the debit instead of bad debt expense. That's the difference. All right, so we're going to make the allowance have a debit of 11,680, and down goes the accounts receivable or that person who the company has determined account is uncollectible. Last one for, all right, the last one for figuring out this allowance. Okay, under the allowance, there are two estimates. Two estimates to make. Okay, and so this is going to be number 9. Yes, number 9. Okay, so let me grab number 9 here. And if you have to go, be on your way. I'll probably go ahead and finish this out. And you guys can look at it if you want to help solve for something you're having troubles with. Okay, so we're going to use this. All right, so this is going to be two allowance estimate methods. So the first one, at the end of the current year, the accounts, so here we're going to use A and B, A, B, C, and D. All right, so let's go ahead and use A, B, C, and D. So we'll use T account and a T account for the allowance. One you use sales, one you use the aging the receivables method to calculate what the adjusting entry will be. Okay, so this can get a little bit difficult, but that's okay. That's why you're in this class. All right, so we're looking at accounts receivable. Put accounts receivable here. Do I have anybody left? A few. That's okay. Hang in there with us. Here's that allowance account. So there's times that we need to know how much is in it. There's times we don't. But they're going to try to confuse you. Allowance for doubtful accounts. Okay. All right. So this first one is A. And I also want to put down the sales. okay, how much it is. And each of these are different. Okay, each of these is different. So I'm going to put the sales in here. We've got sales of 13,090,000. Okay, 13,090,000. And I'm going to just get rid of this. No. All right, let me make a little more room. I don't know why I made that red. Because red seems to be kind of like alarming. Didn't mean to. Let's do this method. So what is the percent of sales for the first one? It's 0.75%. 0.75%. So here's your sales. And we're looking at 0.0075. Okay, so I'm going to show that as a percentage. The right, there we go. This is 0.75%. So here's what they're saying. 0.75% is what they expect will be bad debt. Okay, bad debt, bad debt. Okay, so how much is that? Now this first one is the percent of sales method. Okay, so A is the percent of sales method. Percent of sales. Okay, oh, and here's the debit balance, by the way, in the account. It doesn't really matter. 1,154,000. And once again, our sales are 1390. Okay, for this problem. And I'm going to make some more room here. Insert. So we're going to use this one for the first one, and then this one we'll use the percent of sales method twice, and then the aging the receivables method twice. Okay. I'm going to keep going with this video until I get done here. So bear with me. I only have a few of you left. That's okay. If you have to bug out, that's fine. We at least got quite a bit of it done. All right. And then we want to figure out how much bad debt is. So if you take the total sales times the amount of uncollectible, which is in this first one is 0.0075. We got 98,175. So the adjusting entry is going to be, and I need bad debt expense here. So let me get this shored up. And I need one more account for bad debt expense so that you can see how it works. Okay, so this is going to be bad debt expense. So one more time for the record. When you are using the percent of sales method, it finds bad debt expense. And so you're going to make an entry. You don't really care how much is sitting in here, right? But just for the record, it has $15,600. Okay, $15,600. But bad debt expense is going to go in as the adjusting entry of whatever you find. So we found that bad debt expense is 0.75%. We took it times sales. So the offset is actually going to go right here. And it doesn't matter how much is in this account already, right? So when we use the percent of sales method, it doesn't change. You just put it in. So 98,175 is the first answer. Now we're going to skip to C. Okay, we're going to skip to C, and I'm going to do this again, but we are going to figure a different amount. Okay, so let's go ahead and put it in here. We're going to do the same thing, but with a different percentage of uncollectability. Okay, so here it comes. Same amount of sales. Okay, same amount of sales. Here we go. Okay, so now instead of 0.75%, it's 0.25%. How much will be uncollected? That's their estimate. Okay, remember, estimates are just educated guesses trying to predict how much bad debt expense they'll have. I got 32,725. So that's the adjusting entry. 32,725. It is 0.75% of sales. Okay, so we just found, so let's see if we're right. Yes. So now we're going to do the other one. Okay, now we're going to do the other one, which is called aging the receivables. Okay, so I'm going to bring this down, get rid of this, and we are going to use this. So we'll cut this out and bring it down here. Gotta make myself some more room. Now we're going to use the method that GAAP really prefers when it comes down to it. They really prefer that you have an allowance in your chart of accounts, and they prefer that you use aging the receivables because it actually looks at the age of the receivables when you're calculating how much you want to go in that allowance account. Okay, so one method finds bad debt expense, and the other method finds how much you want, how much is supposed to be in the balance of that allowance account. A lot of words, a lot of language. I know. And pretty soon it all sounds the same. I get it. Okay, let me pull this down. Okay. One more time. Okay, so, and we're going to use these accounts again. Because this time we are going to pay attention to how much is in the account. Okay, so let me go back. I should have gotten all this ready first, but it's the way it goes. I need more room. And you pretty much have to draw the T accounts because you're not going to really understand it unless you look at it. Okay, so we're going to copy this and bring it in. Okay, so this is going to be B. B is in boy. Okay, the same amount of AR, but we're going to watch for how much the balance is in the allowance. So this is B. So the aging the receivables says that when they did it, I'm not going to make you age a receivable, but I want you to understand that the indicates the estimated doubtful accounts balance should be $49,900. That's how much you want in here. That is going to be the new balance when we do an adjustment. Okay, we're going to put a number in this account so that it balances. This is the estimated balance. And that's how much we need it to be. All right. So before we go any further, let's see what the balance is starting with. It has a debit balance of $15,600. So here it is sitting here, $15,600. How much is it going to take to bring it back over to this side, and then it then balances to 49,900. That's going to be your adjusting entry. You're going to need to add those two together. Okay, you're going to need to add those two together. So if you had $15,600 in this account on the debit side, you would need to put a credit of 65,500, which means you would debit bad debt expense for that, so that this account then has this estimated balance. Okay, so the estimated balance is what we want the account to have in it. Okay, that's the difference. The percent of sales method finds bad debt expense. Okay, so let's put our 65,500 there. Now I'm going to do this one more time. One more time for D, and it's going to have a different beginning balance, the allowance will. So let's insert, let's just take this whole thing with us for B. It's a little after 1 now, and I only have Jackson and Monty left. Oh, way. That's all right. Okay, so this last one then has a credit balance on the other side of 9,300. Okay, so then we go down here to the bottom and we read what it says. So they aged their receivables, and when they did the receivables table and aged everything, they want 77,200 in their allowance. So how much is already a credit? It's 9,300. So let's just subtract what's already there, and that becomes your adjusting entry. Okay, I got 67,900. Let's put that in. 67,900 should work. Yep. So this is your adjusting entry. So to make you have to make an adjustment when it comes to accounts receivable, because we don't want our accounts receivable getting too big. We could leave accounts receivable on there for years and years and years, and it would get too big, but it would still look good. Oh, that's an asset. Okay, so it would still look good, but it wouldn't be collectible. Most businesses have a policy that they write off any account that becomes uncollectible after a certain period of time or whatever. Okay, we're moving on now to fixed assets. Fixed assets. Okay, fixed assets. So depreciation is not a reduction of value in the asset. It's actually expensing the asset over time. Okay, so be careful. Just be careful. Okay, just be careful. All right, so this is the revision of depreciation. So sometimes you revise your depreciation. Okay, so let's just, okay, so this is a revision of it. Let's see what I can do to make it happen here. Revision. Okay, this is going to be number 10. All right, number 10. And by the way, I give you 3 hours to do the test. So hopefully that will be enough. We'll talk about it if it isn't. So the equipment with a cost of $370,600 has a residual value of $42,600. Okay. Has an estimated life of 40 years and is depreciated by the straight line method. So here's what we're doing. Okay, we bought equipment, $370,600. It has a useful life of 40 years. So we are not using the double declining balance for this one. Okay, but we might. Okay, use another one. So we'll just try to make this happen. Okay. So we're using straight line. The straight line rate is 1 over useful life. Okay, so 1 over 40. 40 years is quite a while to expense something. It does have a residual, or I'm sorry, a residual value or a salvage value. Okay, so this really doesn't take steps. You just have to have pieces of it. Okay, that thing is back at it again. I guess I'm on here too long. Okay. All right, we're going to calculate the depreciation. Now, because they're using straight line, depreciation becomes pretty easy to do because you're going to have the same amount of depreciation every year. So we're going to find the straight line, right? So the purchase amount, okay, I'm going to calculate the depreciation. This is straight line depreciation. And here's the formula. Straight line depreciation is equals the purchase amount of the asset less any residual value. Okay, and that's all in parentheses. And then you divide by the number of years of useful life. Okay, we're going to divide by 40. Okay, so that's what I'm going to calculate. Okay, so the annual depreciation, therefore, becomes, okay, let me get rid of this. And what is this? Oh, cash. Okay. Well, when we bought the equipment, if we bought it for cash, but we won't go into that because that's not what they're asking. Okay, we're just trying to get through how much the depreciation is. Okay, so now I'm going to calculate it. And I'm going to show you the calculation so you can see it. All right, so that purchase amount is $370,600. And we're going to subtract residual value of $42,600. Okay, and we're going to put that in parentheses and divide by 40. Okay, the good news about straight line depreciation is you get the same amount of depreciation, years 1 through 40. Yep. So what is that amount of annual depreciation? So if nothing else changes, then we're going to the annual depreciation. We need to know how much it is. Okay, so here it comes. Equals the amount we bought it for minus the residual amount and divided by 40. And they want it, it doesn't say if they want it in 2 decimals. I don't think so. So we're going to do, that's going to be our numerator. And we're going to divide by 40. I got $8,200 as my annual depreciation. Okay, let's see if I'm right. Yes. Okay, so every year, years 1 through 20, we're going to put 8,200 in here, right? 8,200. But if we're going to do says determine the book value at the end of year 20. So we've had this piece of equipment for 20 years now. And so year 20, this is how much would be in here. Okay, it's going to be 20 times that annual depreciation. Okay, so there's what the calculation is. And here's for 20 years times 20 years. So one more time, 8,200 times 20 means that they would have accumulated depreciation of 164,000. So the book value at that point, okay, the book value We're not selling anything right now. Okay, so the book value. We gotta know what the book value is from time to time. So book value is that asset of $370,600 minus the residual value, minus the accumulated depreciation of $164,000. Okay, so book value equals. So we have depreciated half of this already. They said it would last 40 years. Okay, so there it is. And then now I'm going to calculate this. That's what the formula looks like. But now I'm going to subtract the accumulated depreciation after year 20. Okay, so I got $206,600 for the book value of the asset after depreciating it 20 years at $8,200 a year. Okay, so that's the new book value, 206,600. Another reason to calculate the book value is how much you have yet to depreciate. And when you're finished depreciating, if you have residual value, that's what the book value should equal. I'm still here. I can't believe it, but I'm still here. Okay, so assuming in the 21st year, the remaining life is now 23 years. Okay, so sometimes things change. So we're and the new residual value is estimated to be 45,600. Okay, well, so we want to know, determine the depreciation expense for each of the remaining 23 years. So here's the book value. They said that the residual value now is 45,000. So I'm going to put that in. Okay, so we're going to take that book value of 206,600 and subtract the residual value. Okay, and then, so let's see what that is, and then we'll divide it by 23 years. Okay, we'll divide it by 23 years. So 23 years is the new projection. So this is the new residual value, revised residual value. Okay, and then the new revised life. Remaining life is 23 years. Okay, so all we want to do is figure out what the annual depreciation is going to be. That's all we have to figure out. I know it seems like a lot. So let's take the amount remaining and divide by 23. And I got $7,026 is the revised annual depreciation. If I got it right, let me try it. I may have made an error. It's always possible. 7,026. Let's see. Nope. Okay, it didn't like it. Just a second. Let me see what I'm doing wrong here. All right, this is going to be for revising it. Just a minute. So we must have, I've got to look. Just a second. We'll find it. I'm going to go those basic exercises of how to do a revision here. I think we have to actually, we're going to do something here. Okay, I'm going to stop the recording for just a moment while I think about it. So just a second, I'm going to pause the Okay, I put in an amount wrong. So instead of 45,000, it's 45,600. Okay, so now I think we're down to 7,000 as our, yay, there it is. It was an error on my part of entering the amount. So you got to find the book value when it's going to be revised, subtract the new residual value if there is one, and then divide by, remember it was only going to last another 20 years, but they determined that it was really 23. So sometimes depreciation amounts change, but after that one, every year the depreciation amount's going to be 7,000 unless something's changed. Let's go to the next one. Here comes the sale of equipment. Okay, the sale of equipment. So we are going to, okay, we're going to use this for number 11 here. So I'm going to move all this down. And this can be a little tricky, as you can imagine. So let me move this down, insert. Okay. And then I'm going to get rid of, okay. I'm going to go down to here. Okay. Are you done? If you need to go, you just go do what you need to. Sorry, it seems to not be very helpful to come to class, is it? Hmm?
I had to call the tow truck.
Oh, a tow truck, you say? Oh, I know how that goes. It's okay. I'm glad you made it. Glad you made it in. So don't worry. I'm I'm videoing right now. So, okay,
Thank you.
sure. I agree. Okay. So, all right, the equipment was acquired at the beginning of the year. So there's one thing we need to make sure we know. Because, okay, so the cost was 560,000. Very good. Let me get rid of this other stuff here. That doesn't help us in this one. So we're going to, this is called the sale of a piece of equipment. All right, the sale. See ya on Wednesday. Next week's Thanksgiving. So we'll see you only one day next week.
Okay.
Only on Monday.
Have you put me in on the minutes?
I will. I sure will. But thank you for asking. Okay.
Oh,
Yeah, I sure will. See you later.
it's-
Uh-huh. Okay, it says equipment was acquired at the beginning of the year at the cost of $560,000. The equipment is depreciated using the double declining balance method based on an estimated life of 10 years and estimated residual value of 56,000. Okay, so there is a process to this. So the first thing you do is you find the straight line rate. Okay, and in this case, it's 10 years. Okay, so 10 years. And let me see what this is over here. Okay, so 10 years becomes 10%. Okay, 10%. Now we're going to use the double declining balance, not the straight line. We do need the straight line in order to calculate the double declining balance. So, okay, so now here's what you do. So then you set up, use double declining balance table. Yeah, you got to kind of make one. Double declining balance table. All right, so I'll show you how that gets done. Okay, I'm going to squeeze this together a little bit here and get rid of this. Okay, and then down here. All right, so the book value. Okay, oh, the double declining rate. The double declining rate. Here it is. Use double declining balance. So the double rate is 2 times the straight line. So equals 2 times 10%. Okay, so this is going to be 20% is our double declining rate. 20%. And I'm going to turn that into a percentage. There we go. So what was the depreciation for the first year? All right, so what you do is you put your book value. $560,000 is how much it starts with. You do not subtract the residual value first before you get started with double declining. They'll take care of that later. All right, all we want to know is how much was 20% of that piece of equipment. Whoops. Piece of equipment. So I got $112,000. $112,000. That is the first year of depreciation. Let's see if that is correct. Okay. Assuming the equipment was sold at the end of the second year. Okay, so we've got to do this twice, right? So what happens here is we start with 560,000, but we depreciate 112,000. So then the new book value, every time we depreciate it, a new book value is going to come in. So the second year is, so here are the amounts of the annual depreciation for the first 2 years. Okay, for the first 2 years, this is called accelerated depreciation. So you accelerate it, you use the most the first year. So I'm going to put, just a minute. Okay, so I'm going to put year 1 here to show how much came in, 112,000. And then 41,000, let me go down here, 41,320. Okay, 41,320. All right, so the book value, so how much is that? So if we did year 1 and year 2, we've got to know how much is in accumulated depreciation. Right? So the book value, which I think is what they're, okay, assuming the equipment was sold at the end of the second year for $450. So here's what the sales proceeds are. $450,000. Here is the book value, right? The book value and the sales assets at the end of the second year. Okay, they sell that asset at the end of the second year for $450,000. So this is why we keep track of the book value, is because if we turn around and sell it, we need to know if we sell it for a loss or a gain. Now here's the thing. The book value is only $165,280. But we sell it for $450,000. So when the sales proceeds are larger right? The sales proceeds, and I need to change this. When the sales proceeds are larger than the book value, you are going to calculate a gain on that sale. Okay, so yes, the sales proceeds are. So this is going to be a gain of how much? Well, it's going to be a gain of 284,720. Okay, so this is a gain. Now remember, losses are debits, gains are credits. I'm going to put this notation over here to get it out of the way. This is actually a gain. Okay, this is a gain because the book value is less than the sales proceeds. So book value is less than sales proceeds. So that's how this is going to work. Okay, and there should be the amount of the gain. So I got 284,720, and we've got a gain. Now I don't know if everybody is supposed to get a gain or if there's a chance of it being a loss. Okay, so let me go ahead and see what I've done here. We got the first year depreciation. And we might have to go to 2 decimal places, but we know it's a gain. Okay. And these are the steps. These are the steps. So sale at the end of year 2. So let me double check. Okay, so then that is the, did I put it in? Okay, hang on. Assuming that it sold at the end of the second year. So they're being nice to you by telling you that they're being nice to you because you can just put in that second year of, let me just go double check here. So here it is. Uh-oh, hang on. There's that. Okay, so I'm going to check the book value here. Book value equals 560 minus 153, 406,680. Oops, sorry about that. I don't know yet. Where'd I get that? That's a good question. Okay, just a second here. So that's okay. So then the beginning is going to be the book value, right? It's going to be this minus the first amount. Yep. 448. There it is. There it is. There's what's wrong. Okay. Okay. So at the end of the first year, here is our book value. Okay, when we subtract 89,600, let's go up here and put 89,600. That means the book value is 358,400. Yes. Now we have a gain. It's still a gain, but it's not as much. So here is the book value at the end of year 2. Yep. After we have accumulated 201,600 of depreciation, the book value becomes 358,400. If we sell it for 450,000, we're going to have a gain. It's just a matter of us calculating it. So now here comes the journal entry to record the sale. Okay, record the sale. I always put cash in first. Cash is going to come in for $450,000. Yep. Okay, we got to get rid of accumulated depreciation, 201,600. We got to get rid of the equipment. And then the gain on the sale. Okay, gain on the sale. I'm going to put that over here. So let's put in cash of 450,000. And to get rid of the accumulated depreciation, you have to debit it for its total. Then you credit the account that has the equipment in it for however much is in there. And then we need another credit, which is 91,600. That is a gain on sale of equipment. Gain on sale of equipment. And I'm going to put that one here. Gain on sale of equipment. That's actually an account. Gains are credits and losses are debits. Okay, so we want, okay, so here's what's going on. 91,600. So this debit and this debit must equal this debit and this debit. Okay, so I must have had a loss the last time I did one of these. Okay, so let's see if we're right. I know that's kind of tough. One more. This is depreciation by two methods. Depreciation by two methods. One's the straight line method, and the other is the double declining. Those are pretty easy to do together. There we go. I just need to shorten my depth here. And there's the steps for selling a piece of equipment, which is, it's tough. It's tough, but we're tougher. Let's try to get through this. Delete. Okay. Okay, this is number 12. Okay, number 12. Straight line depreciation, double declining balance. We have 10 years. The residual value is 0, but we checked it. It happened at the first of the year. So the tractor is $70,000. Okay, $70,000. And so the straight line rate is 10%. Okay, so 1/10. So 10, and then that means the double declining is, so 1/10 is 10%. And I'll turn that into a decimal. Okay, and then the double, okay, that's straight line. Actually, I'll put straight line right here. Straight line rate. Okay, so then that makes the double declining rate 2 times that. So double declining. Is going to be 20%. Okay, so we'll change that to a percentage. 20%. All right, so straight line formula. There it is. Cost minus residual value divided by the useful life. So let's take 70,000 and subtract 0, because at least we watched for that residual value. Okay. All right, so $7,000 is going to be the first year and the second year of depreciation. Okay. Okay, so that's good. That's what's nice about straight line, is once you find one year, then it's the other. Now let's go do double declining rate. So once again, we're starting off with $70,000 asset, We're gonna take 20% of it for the first year, which is gonna be $14,000. And then we subtract that 14,000 from the 70. So we have a new book value of 56,000. 56,000 times 20% is $11,200. So I think we're okay there. That one's not bad. Okay, last three have to do with liabilities. Okay, liabilities. So the first one I want to do is the gross. So I'm going to bring this up there. So hang on a minute. The net pay. Let's figure out how to do net pay. There it is. Okay. Okay, let's put in the gross pay. So the gross earnings were $990. Okay, federal income tax withholding. Now be careful. This is when we have to use two decimals. All right, so we're going to take out 188.10. And then it is going to be 6.2%. And then 1.45%. That's Medicare. Okay, now we need to do the math here. We need to add a little, there we go. And that one gets 145. And then we do the math. Okay, what is the net pay, right? So one more time, you take the gross, the federal income tax calculation is beyond the scope of the class, so they're going to tell you what it is. You're going to take your gross times 0.062, and then the gross times 0.145, and I got 726.17. Now, I'm going to do this on my calculator. Actually, I'm going to key this in. I'm going to key it in. I'm not going to make it calculate. I'm going to key it in. And sometimes this is what you have to do for payroll, because sometimes Excel tries to help too much. All right, now I'm going to turn this into, there we are. And now I'm going to do this again, because sometimes we have a little rounding problem and it won't fix itself. Okay, so let me bring this down here. Boy, it really gives me troubles doing this. Okay. And it shouldn't. There we go. I got 726. Now be careful. Let me see what I got. I think there's going to be some sense there. Okay. So let's. Okay, I got 726.16. Yep. When you key it, it's different than when you take it times. So there's got to be a rounding feature, but I just don't have time to look it up. All right, so I believe if you get something like that and you do it in Excel, make sure then you just key it in to see what it turns out to be. Okay. A note, right? A note. So let's see if we can't do, okay, and then this note, is that's going to be the last one we do? Yes. Yes. Okay, so let me move this down. And then we'll be done. I know. I may shorten the test. Ha! I didn't realize how long this was going to take. My gosh. And my goodness. I know they're basic exercises. So It's okay. We're gonna make it. Okay, this is gonna be number 12. Okay, and then 10. Get rid of this. Oh. Oh, okay. Wait a minute. Get rid of these. Delete. Okay. Now we're going to do. No. I missed it. Hang on. I want to keep this. I want to keep that. Let me get rid of this. I have it down here, don't I? Yes. Okay, so let's get rid of this. Delete. Okay, so this becomes, we did this one. Now we need more room. Insert. We're going to take this down and put it in. So just to refresh your memory, your employer, while employers pay employees a wage, there's other costs that an employee causes because when an employee pays into Social Security and Medicare, the employer has to match it. Okay, so that match costs the employer more. All right, so let's go ahead and look here. Let's go back and get this one. All right, we're going to calculate this. So, oh, okay. Oh, I thought that was going to work. Well, I guess not. Oh, yes, it is. Sorry for all the trouble. I need this as number 11. So this payroll actually gets keyed in as number 10. Oh my goodness. So this is number 10, this is number 11. And then this is number 12. Okay, I'm ready now. All right. So now let's look at okay, I guess I don't have this. That's fine. Let me go get this. I'll be right back. I'm going to put this on hold a minute and then I'll be right back. Okay, I think we're back. All right, so I brought in a problem that I had elsewhere. So we're going to figure out the payroll. So once again, an employer has to match employees' Social Security and their Medicare contributions. So that's another expense to an employer. And then they have to pay in to state unemployment and federal unemployment. All right, so let's see if we can't figure it out. The payroll register indicates that we probably don't need all this. This was a lot bigger problem. but we're trying to create something like this right here, this one here. Okay, this is what we want. So we're going to put all this stuff in and we're going to find payroll expense up here. So you might as well just go ahead and put payroll expense and let me get rid of all of this stuff here so that we can look at it with the T accounts. Okay, so we don't have all these deductions. But that's okay. All right, so this was paying and then making the payroll tax entry. That is a different. The payroll tax entry happens after you pay people. So, all right, let's see if we can do this. So all you have to do withheld on total salaries of $70,000. Well, all these here don't matter, and 70. So total salaries here is what we want. $70,000. Okay. Yep. 70,000, and then we want 6.2. Oh no, they're telling us how much. Okay, so we don't have to calculate anything. All right, so here's what we're doing. Here's the gross salary. So we're going to put in Social Security payable. There it is. Whatever they're telling us. Okay, we're going to put that in. So $4,340. And then the Medicare payable part. Okay, that gets matched, which doesn't this time. The Medicare tax payable is $3,150. The federal withholding, okay, federal income, the federal withholding for the period. Oh, this is not the payroll tax expense. This is the putting in the salaries. Okay. Says journalize to record the period's payroll. So it isn't. This is not. This is this one. Okay. It was just got one line. So here's what we want. Let me take out what I thought it was. My goodness. Okay. So there's no state or federal unemployment, but we are going to put this payable here and here. Let's put the amount that they withheld for employees withholding of federal income tax. And then we have one retirement savings, which we can put right here. Retirement savings payable. All right. So they withheld 2,500. All right. So then are they paying the people on that day? Withheld from employee checks were 2,500. Withheld on total salaries. Okay. So journalize the entry. So this is going to be total salaries. Salaries expense. That's why they gave us the 70,000. Yep. Okay. Salaries expense. Put it in. And that's going to go here. Okay. What we're going to solve for is the very last credit. Okay, there's the amount that we are paying. Okay, so then we want Social Security tax payable, which is the 4,340. Then we want the Medicare tax payable of whatever they're telling us. And then the federal income tax employees payable. Remember, all of these are payables because remember, this is a liability chapter. And then the last one is the retirement deductions payable. So now we're sitting here and I don't know if it's cash or nope, it's not cash. This is going to go in salaries payable, not cash, because it's not payday yet. So this is salaries payable. Okay, this needs to go across this. Okay, so you find this as the last piece. Okay, you find this as the last piece because it's the plug number. Okay, the plug number, so equals. So we're going to start up here with the 70,000 and subtract the Social Security, the Medicare. Okay, the federal income tax withholding for the, okay, we're not quite done yet. And then plus, oh, no, minus. Okay, we want minus, another minus. There it is. So once again, this is the plug number that it takes. So I got 48,110. Okay, now just for fun, so it doesn't get any weirder okay, I'm going to add it up. That's not what the Medicare income tax, that's not the employees. Employees is $11,900. There we go. Okay, 11,900, 2,500, 48,110. So let me see what that comes to. Yep, it comes to 70,000. Hey, there we go. So check your work once in a while. It's worth it. Okay, I think that's it. We've got one more note. Oh boy, I'm gonna shorten the test. Okay, so you'll only have 2 questions. So 2 times 5 is 10. I'm gonna take 4 of those off there. Okay, so just a second, we'll get this done. This last one is a note payable. Okay, a note payable. One is a simple interest-bearing note, and the other one is a note, a discounted note. Okay, I think. What's happening here? Just a minute. Nope. I want this last one here. Okay, entries for note payable. Nope, this is the buyer and the seller. Okay. Okay, I thought we were going to compare. That's all right. Let me get rid of this. But you will have earned your 50 points once you have completed this. Okay, so I will probably take off the harder problems. It just depends on which one you think is hard, but they're all hard when I get it. So no border. All right. Okay, I'll be right back. Okay, this is going to help you, or this is going to show you what it's like to see both sides of a note. It's the one borrowing the money and the one loaning the money. All right, so let's get started. So Bennett Enterprises issues a $940,000 120 day 10% note to Spectrum Industries. So Bennett is the borrower and Spectrum is the loaner. Okay, the loaner or the seller, basically. Bennett is the buyer, Spectrum is the seller. So let's go ahead and calculate how much the interest is supposed to be on this note for 120 days. Okay, so we want 10%. Okay. Then we're going to issue the note. So let me go ahead and I like to know how much it's going to be. 10%. Yes, go ahead. going on? Why? Okay, so I'm sorry if you've had to, we're going to go through this here. All right. So it says we did this to get, okay, so Bennett issues and then they do it for merchandise inventory. All right. So here is the inventory coming in. Whoops. 948,000. Okay. And then the note, 948,000. Okay. So that's issuing the note, but he got inventory for it instead. Okay. And the face of the note always goes in the note payable. Okay. So now he's going to pay it. He's going to pay it. So I calculated 31,000. So 948,000 times 10% times 120 divided by 365. So down goes cash for paying it off. Okay, so I went ahead and did that. So then, okay, interest, okay, and then cash. So if we pay this when it's time, down goes cash of the full amount, 427,167. That includes a debit of 948 and interest of 31,167. So, all right, so interest expense. Well, oh, notes payable. All right, they wanted to do the note payable first. Okay, so get rid of it. And the cash is the whole amount. And interest expense, okay, is the 31,167. So I hope that's correct. Uh-oh. Hold on. Okay, so this one I'm just gonna add together here. So 948. Here we go. This is 948. That's what's wrong. Okay, so here is, yeah, sorry, 979,167. There we go. So here's how much is being paid to pay off the loan. Okay, and that includes the interest. There we go. Okay, now we're going to show what it looks like from the lender's point of view, right? They're going to loan out 948,000. Okay, so that's to get things started. And then we don't know how much, we didn't do the cost of goods sold here. So that's okay. And then the cash that's coming in. All right, so let's show the note receivable. So we put this amount in a notes receivable, and it was inventory. Wait a minute. Receipt of the note. Yep. So, oh, sales, of course. Good grief. I was trying to take down inventory. Okay. All right. There we go. All right. So then when the cash comes, we've already determined how much that is. That is the 979,167. Here comes the cash to pay it off. And then we get rid of the note. And we consider that interest revenue. Yep. So get rid of the note receivable for the full amount. And the interest revenue. So what is revenue on one side is interest expense on the other. But it does all have to jive. 979,167. Okay, I think that's it. Woo! All right, that's it, guys. Golly. Here we go. Thank you for being so patient. I'm sorry that this took so long. No, I'm not going to make you do this many problems. I didn't realize how long they were going to take. So, not going to do that. We'll do 10, and that's just like we did for exam 1.